But it's really going to come down to what the borrower and the seller are going to be able to come up with. We're going to give you high level indications, but I would say you would want to raise it, just rule of thumb, about 10 basis points a year of hold. So if you go in at 650, you're going to sell this at 7. There's your value.
Hello. Ginny Bolling here with Pivotal REI, the Pivotal Real Estate Investing Podcast. And today I have Julie Anne Peterson with us. Julie, thank you for coming on.
Oh, thank you so much for the invitation. I'm looking forward to a very interesting conversation together.
Yeah, we've probably known each other since 2022. I think I met you one of the first conferences I went to.
Oh, okay. Yeah,
And
I know it's been a while.
yeah. And I was with Raise Masters initially.
Right. Okay.
And went to several. I started going to conferences right away because I'm a data hog. I like to know what people are talking about and thinking about, right? So,
Yeah.
and you are always front and center, knowing everybody and knowing what's going on. And so I'm going to read your bio, but I would be remiss not to say that you're not only a super connector, but you're also very present. So not only with people, but places. So yeah,
Oh, yeah.
very good.
I get out. Yes.
Yes, you do. All right. So, Julie Ann, I call Julie because that's just how I learned you. But you are, as you say, introduced as Julie Ann. So, um, graciously referred to as the First Lady of Lending. And I'm going to call you the leading lady of lending. You're a senior director of Old Capital Lending, a nationwide premier provider of commercial capital solutions and advisory services for multifamily and commercial real estate. With 36 years of real estate transaction experience, Julie does not just source funds, she consults with her clients to help solve their immediate needs. Julie personally invests in commercial and multifamily assets as an owner, operator, and limited partner in Texas, New York State, and Georgia. She has raised $20 million from family and friends. She is knowledgeable in using 1031 exchanges and self-directed or solo 401k type of accounts. And have you heard of Zoom at 8? She is famous for promoting the podcast called Zoom at 8 and is wildly successful. Weekly meetings were developed 7 years ago and uniting new and seasoned investors to understand the importance of education and building relationships. And I always have conflicting things on Tuesdays, but I love it when I get onto yours too. I try to
Oh,
sneak
thank
in
you.
at least a portion, but yeah. One thing is for sure, you will always find Julie bringing her ability to connect people, strength and knowledge of banking, capital raising, and asset management to all of her commercial real estate opportunities, along with the energy that she has. Outside
Thank
of
you.
work, Julie enjoys spending time with her husband, 4 children, and Walter the dog. What kind of dog
There's
is
oh,
Walter?
a Bernedoodle. So a combination of Burmese mountain dog and poodle, and it's a perfect fit.
Right. Well,
Yeah.
feel free to show us a picture during the show if you'd like. I can't picture a
He may be
Bernadette.
around here someplace
Oh,
showing up in
okay.
my office. So
Well, so like I say, though, I see you a lot of places. I consider you a true authority on many things lending, as well as
thank you.
analysis and all the rest. And so, what I want you to go ahead and tell us here at the beginning is what you want the listener to take away from our talk today.
Most importantly, and again, this is because I'm an owner operator. I have been in relationships with partners. So I say, your partner, you got to know your partner. Know your partner. That would be my advice. Um, because these are the people that you're going to do business with for at least 5 years on a deal, could be even as long as 10. So know who you're doing business with.
Yeah, I want to know, like, and trust them too. For
Have the
sure.
same vision and values.
Yeah, yeah,
So,
yeah.
mhm.
It's like getting married, right?
Absolutely, you will be married to your partner. I have mentioned this to other people that go into business together, and they say, before we put our operating agreement together, we also had a what is our agreement when we separate. so that everybody knows how the game is played. I'm taking this, you're taking that. Everybody's in full agreement. And I probably should have done that in some situations. So you understand the rules of the game.
It's funny as you say that. I hadn't really thought of it that in that much parallel, but since I did eminent domain most of my life, I would constantly be crafting agreements with property owners and their attorneys. And it's always, okay, worst case, this is what's happening. And we had
Hmm.
to define every detail, every
Yeah.
detail. So,
Yeah.
yeah, especially if you're cutting into buildings and messing up lives. Yeah,
Yeah.
but
Completely.
that's good advice. All right. Well, so why don't you talk about if, say, I found a deal, or you have a case study ready, right? Do you?
Yeah, I mean, I can share with you a deal that I was involved with.
Okay.
Um, and I have two case studies. One that I'm going to be an owner operator, and then I also have one where it is I provided the debt. So let's go with the provided the debt because
Yeah.
there's a lot of this going on right now. So a lot of people in multifamily specifically, and we're specialists in multifamily, but we will provide debt for all of the asset classes. So this um, this case study is for a multifamily property that was bought in 2021, just at the end. And as many of your listeners may know, we were in a rush to the top. We had such great success in the late 2020 years, 2019, 18, 17. So many people got involved. In 2020, we have COVID. And the government is printing lots and lots of money. Anybody on the street was saying, what do I do with this money? And all of their friends were getting all of this capital. So a lot of people jumped in as capital raisers and got into deals, and we put bridge lending on these deals. Why bridge lending at this time? Well, because the rates were based on SOFR, which is your short-term Federal Reserve rate, and those were at point 0.5. At one point, it was at 0. It was cheap. And then you'd add the spread, and the spread, which is how the lenders get paid, was 2.5, 3%. So people were jumping into these bridge loans for 3% on a huge multifamily property. It was incredible. Not only that, these bridge loans would give you up to 85% loan to cost. So you'd have 75% of the value of the asset, and then they would roll in 75 to 100% of a CapEx budget. You couldn't get that on agency. And we'll probably talk a little bit about that. So, this particular asset, we first tried to get it to agency, and it was a smaller tertiary market. So, they would only allow 65%. And your debt service was instead of 1.25, that's the coverage to make sure that the lender is going to get paid. It was not 125, it was 135. And so what happened is the proceeds got cut significantly. And we were running out of time. And so we pivoted to a bridge loan. And at this time, the loans were around 3.75. Well, this loan was a fixed rate loan, 2 years plus an additional 1 year plus an additional 1 year. So this group could be in this asset for 4 years, interest only. It was amazing. They had all of this money coming in. They could do the renovations, and all they had to pay was a very small amount to the lender. So a lot of people jumped in. This particular loan was at 599. Everybody else was at 3.5. And it was because this was a smaller tertiary market. And at the time, 599 seemed incredibly high.
Percent
And
interest.
today, yeah,
Yeah.
percent of interest.
Mhm.
Today, these loans are going for 9.5% loans, right? And while you might be able to get 75, we're not really seeing 85% loan to cost. So these guys have been in it for the 2 years, then they extended it, and then they extended it. Okay. All the while doing renovations, they ran into some troubles. People, now, as you may know and recall with your other speakers, the rent increases that people had thought they were going to get, they decreased. So maybe they had underwritten 5, 8, 10% increases in rent. Now we're at zero, maybe even negative. So people were rushing to reduce expenses, try to keep people in the deals, into the units. Anyway, this group were at their maturity. So we went first to a product that was a 5-year interest only loan. Hey, this is great. We were under contract for this loan, and they said around December, maybe it was November, we're no longer going to be doing loans in Texas. So we're left. So we pivoted to agency, and we're under contract to get an application. Took 6 weeks. We're waiting and waiting and waiting. This is right before Christmas. Then we get a phone call saying we're we're not going to do loans below 10 million that are in a tertiary market and that can or require some exceptions. And we were looking for an exception on this to get a little bit more proceeds. Therefore, we got dropped. So here we're into this since July. Now it's December and we're getting more bad news. So that original company, that original lender came back and said, hey, we're open in Texas. So we were able to get it back under application. We had to call up the lender because the maturity was in December. So we called up the lender and said, hey, we need an extension. They had told us no more extensions. They gave us an extension because we had the lender on the line, and they gave us a order, so a 3-month loan for 10.49%. So we didn't want to be holding that loan for very long because we were at 5.99. Now we doubled our loan interest rate. So we just closed, and we're at 6.7, which is where the market is right now on a 5-year interest only loan. We're excited. They're going to now hold this loan for another 5 years. A lot of people in this situation are either selling at even or a loss, or the banks are taking these assets back. So it's a success story in this difficult market that we were able to refinance. They were actually able, we started the loan at 3.9 million and we closed at 4.4. So they received another 500,000 in proceeds. So really great success story. We're not hearing a lot of success stories now, so I'm proud of that, and
Yeah.
held their hands along the way. So I,
And
I'm
your role in that was,
I provided the debt on that. So I engage. I'm a broker, so we open up our trench coats, and we have thousands of lenders that we can go to. Now, as a broker and with lenders, you want to have execution certainty, meaning you can throw this out to 2,000 lenders. But if you don't have a relationship, if I don't have a relationship as a broker with these lenders, it's a crapshoot, right? It's like, well, hopefully, Hail Mary, we can close this. But we've been in business for 38 years and we have special relationships. And so when we put it out to our network, we pretty much are confirmed that we're going to be able to close, and we underwrite early on in the transaction so that if the asset continues to perform where we are today, we're going to get you these proceeds. There's a lot of brokers out there that will kind of buy people's business. They'll tell them, hey, I'm going to bring a $3 million loan, and then they know that they can't. but they're not going to tell the client that. So you have to be really careful. Again, know who your partners are. We are a partner in your business, in your transaction. So know who you're working with and that they have a good track record. And so in this case, we were a great partner for our client.
Yeah, that sounds like it. And that illustrates a lot. You're right. That was a great case study to talk about what's going on out there because we know there's stress in the market and there is a lot of things happening. I'd like you to talk a little bit about that situation with projecting rent growth because it's
Sure.
very delicate. And so for instance, what I want you to try to explain is, on the one hand, on these value adds, you know that you're adding value and there's going to be a bump in rent for those, which is one set of calculations. But then there's also inflation that a lot of people, of course, need to think about too. How do you work the two of those in your underwriting?
Yeah, so we really, and it will depend on what product we're looking at. If we're looking at a bank loan, that's going to be different than an agency loan, and it's different than a bridge loan. So let's unpack a bridge loan because that's what I just spoke about.
Yeah,
When we're looking at a bridge loan, we're looking off into the future because a bridge loan bridges you to a stabilization. And a stabilization would be, let's say, a 90% or more occupancy. It also could be stabilized as in we got the rents up because you could be buying an asset at 90%, but it's unstabilized because there's a real opportunity there to raise the rents if you do all of these renovations. So on the bridge side of it, we're looking more for where do we think in this market, in this time frame, where do we think the rents are going to be? If I put $1 million into this asset, am I going to be able to realistically raise the rents 5, 6% in this market? And it's difficult to see that. Now, if you're going into the Midwest, let's say, where there hasn't been a whole bunch of construction, a lot of deliveries in the Midwest, doing a value add proposition with a bridge makes more sense for a lender than doing it in, let's say, some of the Sun Belt states where we've delivered more units. We have had a difficult with absorption. We've got concessions coming on board. And by concessions, I'm saying, hey, you sign a 14-month lease and we are going to give you 2 months free. That's a concession. And in these Sunbelt states, if somebody comes to me and says, hey, I'm going to raise rents 5 and 8%, I'm going to say, no, you're not. Let me see what the market is. Again, we're going to go to appraisers. Appraisers, Ginny, you know very well that at the end of the day, the lender's going to put a lot of their knowledge and their respect into the appraiser. If a lender says, hey, I'm going to give you on the repairs and maintenance line, you're saying it's going to be 900 a door. An appraiser might say, I know this market, it's 1200 a door. And maybe the lender said, oh, it's 14. You're saying 9, lender's saying 14, appraiser's saying 12. We'll go with the 12 that the appraiser says. So when we underwrite these deals on bridge, we're taking this all into consideration. We're giving you an estimate of how we see it. But at the end of the day, it's going to come down to validation with the appraiser. Okay. And
right.
we do all of that work up front. Instead of saying, hey, high level, it's going to be, 5 million instead of 3 million. I'd much rather deliver saying I'm going to come in at 2.9 and be able to deliver 3. So, so that's on the bridge. When we talk about agency financing, that's your Fannie and Freddie, non-recourse. we're looking backwards. What is the current owner? How are they managing this property? Because at the end of the day, they would be raising those rents if they could. So we're going to really look at what's in place now, and we call it in place cash flows. And we're going to give those proceeds based on how they're doing it. And when it comes to rent growth, again, we're going to talk to our appraisers in that market. We're going to talk to we're going to know what we've closed uh, in that market. We have market knowledge with the brokers that we work with. So is it a 7 cap? Is it a 6.5 cap? All of that comes into consideration. And we're really looking at what the rent growth is today and speculation. When we talk about bank financing and we're talking about rent growth, there too, they're going to look a little bit into the future, but they too want to see cash flow. And we call it global cash flow when it comes to banking. So, yes, we have an asset that is cash flowing, hopefully, but what happens if that rent growth goes down? Where am I going to these owners? And do they have money that I can go to take their money to manage this property? So it's called global because you're going to sign on a loan, on a recourse loan, but we have to know that we can come after you personally. Okay, that's the difference between bank and agency. One is recourse, one is non-recourse. The recourse, we're looking at you globally cash flow versus just the asset itself on non-recourse. I hope that makes sense.
Right. And the segue is the personal guarantee that gives the bank the right to look to the sponsor's assets, right?
That's
And
correct.
their
Now,
liquidity and the rest.
at the end of the day, everything is personal guarantee. If you default on an agency loan, they will take that money, that they will take that asset back, but you won't do business with the agency again. It'll be difficult. They won't come after you personally unless we call it carve outs, where you would sign that I'm not going to do anything illegal. So if they found out you're doing something illegal, it becomes the same recourse, just like those bank loans. So at the end of the day, you're signing on a loan. Is it personal? Is it not? So um, really, when we talk about small balance loans, um, we're going to see a huge difference in the landscape moving forward. Okay.
Ding
We
ding,
talked a
listen
little,
and listen. This
yeah,
is awesome.
this is a
Yeah.
big deal.
Yeah.
And this is on the multifamily side. Remember, the agency, which is a government agency that owns Fannie and Freddie, which happened in the great financial crisis, they said, we want to provide homes, a place to live for all Americans. So their mission is affordable housing for all Americans. Well, they have learned over the last 5, 10 years of being in multifamily with these agency loans, that they learned and they got burned in this time frame, and they're now adjusting who they're doing deals with. So on the on the agency, again, you've got Fannie and you have Freddie. And there are different types of loans. On the Fannie side, they have well, they don't call it small balance, but it's small balance. 1 million to 6 million is your small balance. And then they go conventional, 6 to millions. Wait, really 100 million, whatever. On the Freddie side, they have a small balance. They call it SBLs for small balance. 1 million to 7.5. And then from 7.5 up is conventional. This small balance is going away. April 30th, it's going away.
That's
So
soon.
any loans that you were thinking about taking and getting on small balance to Freddie is no longer an option. And deals today are difficult to find lending. These are non-recourse. So you would pivot to your Fannie. Well, the great thing about Freddie is Freddie was great for new people. It was a door that opened for new investors. Fannie, you really have to have some qualifications. 3 to 5 transactions, 3 to 5 multifamily ownerships in a period of 2 years, or one for 5 years. And you then would qualify, or your team would qualify for a small balance Fannie. So this goes away. We have Fannie with your guidelines, or you're going to need to go with a bank. And a bank is recourse. So this is going to impact a lot of deals because if you're new, you're doing smaller deals, the 1 to 6, $1 to $7 million loans. Where do you go? You're going to go to Fannie with the right team or with the bank. And with the bank, you're going to need that global cash flow. And we can dig in a little bit here, but if you just think about how the financing is, a Fannie loan has 5, 7, 10-year loans, 12-year loans. Okay. A lot of options. They also do interest only periods, 1 to 5 years, maybe even full term IO. These are 30-year amortization. So your interest, your monthly payment is smaller because it's based on paying it for 30 years. When you go to bank, you're on a 20 to 25-year amortization. So your monthly payment is going to be higher, and you're probably going to get either 3 years or 5-year loan. Not necessarily, every bank is different, but not necessarily a interest only period. But there are, again, there's 2,000, 3,000 different lenders. So we will scour the market so that we can hit all of your determining factors that will help you get your returns. But at the end of the day, this is going to impact where you go for your lending and how profitable your loans will be or your deals will be. Because your banker is your biggest partner in these deals. We're bringing anywhere from 50 to 80% of the proceeds, right? So if we're saying on a bank loan I can only get to 50, you have to bring in the extra 50%. Where's that going to come from?
It's huge, huge change. Do you
Mhm.
think it's going to slow down the market, or do you think the banks are going to get creative and start doing new products?
Everybody's going to need to pivot. So I think
That's
the
three times.
banks,
You get extra points, by the way, when you say pivot.
yeah, oh good. The banks are they want, I mean, at the they want to know who their operators are. They want them to be local to the transaction. Where agency, you could live in California and own in Dallas or in Florida. A bank loan wants to know you. They want a relationship because the way that banks loan is you put money in their banks at 4%, they loan it out to you for 7. Okay. So they want your deposits. So when we're doing bank loans, they may say, hey, Mr. Operator, I need $250,000 in addition to your 30% down. Not a lot of people have that. They need to know, how banks work. So we spend a lot of time up front with our investors to say, okay, let's educate you. What do you and who do you need to be on your team to get these deals done? And again, on the bank side, everybody's going to sign. And not everybody wants to sign personally. They want to be removed. They want the non-recourse. So yes, I think this is going to impact deals significantly. Yeah.
Right, right. Now, an interesting thing that's happened with the stress in the market is the rise of private equity providing debt, right? Are you seeing
Providing debt,
anything?
but also providing equity, right? I
And
mean,
correct, yes. Um,
so yes, it's a very big challenge. And on the equity side, when you go to a preferred equity or you go to a JV partner,
mhm.
they want newer assets. They want 1990s and above, and some are start at 2000. So if you're looking at a value add proposition and you need 30% down, I'm bringing 70, you need 30. And you, let's even call it a $10 million deal you're buying. I'm bringing seven, you need to bring three. And you only have capital raised 2 million, you need an additional million. It's going to be very challenging to find a equity partner, a preferred equity or a JV partner who's going to come in on that deal as, let's say, as debt. We call it equity, but it is debt because you're going to put them into the deal and the deal owes them a certain percentage. And nobody wants to be writing $1 million checks. They want $5 to $10 million checks. So the equity today is extremely challenging. And we all know that it's because many of us, invested in multifamily since 2018, 19, 20, and have lost from 21 to 25. We've lost money. And so, again, knowing who your partners are, do I want to go to a new group or do I want to go back to the people that return capital to me and do they have any deals? And I'll put some money into their deal. Again, some of the challenges that we're going to be facing with new investors coming in, new operators coming in with the debt and the equity. It's a real challenge.
It will be, yes, for sure. That was interesting. You said that from 2020 to 25, losing money. Do you mean that across the board, or do you, I mean, it's really deal by
I
deal.
would I would say a lot of people put money into deals in 2021, 22, thinking they were going to make money pretty quickly, and they never saw any distributions. So they didn't necessarily think they were losing in 2021, 22, but it's come to realize that, hey, I'm not going to get any distributions. And by the way, I'm done with my 5 year interest only loan and I need to get out of this. And to get out of it, I may have to bring in another $5 million. And that's going to be coming to investors. They're going to get the call. Hey, I know you put 400,000 into this. I need another 200,000 so I can keep your 400 from being lost. How many of us want to do that? Do I want to lose 400? Do I want to lose 600? So this is this we're trying to come up with solutions. And the market without having rent growth and expenses, the NOI has remained the same or has dipped. So and with that dip, the cap rates have also increased. So their values have been lost. We thought we were going to sell this at 20 million. It's not worth more than 15 and I owe 16 million. It is something that if you haven't been exposed to it, you will be exposed to it in the next year to 2 years. All of these deals that got in 21, they had 5 years. That's 2026 right now. So if you got into it in 21, 22, that maturity is coming. And to find new lending to get you out without losing is nearly impossible.
Right. Yeah. So much of that is going on. The banks did at least learn to get more creative after the Great Recession, I think.
They
They
did.
are modifying loans, right?
We are modifying loans. Um, but at some point, there's no more, right? They either
Mhm.
say, hey, I've got a buyer and you're going to sell it to them, or you're going to need to bring in the $5 million because I don't want this on my my uh,
Good.
books, right? I don't
Yeah.
want to manage this. So we're going to move right now. We're going to sell this or we're taking it back and you're going to lose. And at that point, if an operator doesn't make the payments, now they're in default and we go from non-recourse to recourse. So
So
the conversations are extremely challenging with these lenders.
this is exactly what I talk about in my emails and my
Uh,
newsletters, that the
mhm.
kicking the can down the road, that, everybody was hoping the rates were going to come down by now.
Yeah,
And the fact is that we've hit the wall, right? And
we have.
so
We've hit a wall, and with no rent growth or even loss of rents. I mean, the best thing that's happening right now is a lot of people don't want to move. There's uncertainty in the market. We are in Iran crisis. People, they just let off 30,000 people from Oracle, Amazon. People are wanting to stay. And so a lot of the operators have been able to get an increase for those that are renewing, but finding a new tenant, the new resident base has been challenging, right? Especially in the older assets, in the value add. We have also seen ICE show up in some of these properties, and they're losing, they're finding 15 keys in their mailboxes. They've lost residents. The last thing I heard yesterday was that these residents do not want to stay in a place more than 1 year. So if they didn't leave, they're going to be leaving soon. So, it's not only the lending, but we have a lot of geopolitical stuff going on in the market that is really impacting these deals. Residents, expenses, there's just a lot. I don't want to call it a perfect storm, but it's a hurricane.
yeah, it is. And when there's blood in the streets, that is when you should be paying attention, is also what I say. And but you've got to be just so careful with how you underwrite and all the variables.
Yeah,
So
you mentioned something there, Ginny. It is the time to be buying. It is the right time to be in considering these deals because I can't be off my computer for too long because we are getting so many opportunities. It's constantly, hey, this 56 unit, this 114. I mean, it's constant new product. Well, new things are coming on the market that you might want to consider at pricing that you may not see being held for another couple years. It's going to go up. We're going to be absorbing this new product. And to build new product now, I mean, it's it's going to be 2 years away, 3 years away from new product coming in. And with the tariffs that are being impacting the construction products, to be able to build these assets at the price that you're getting is pretty difficult. So thinking about, how you can underwrite very conservatively and be able to look at these opportunities as a long-term strategy. We're no longer turning assets in 18 months. It may take you 7 years, and that's okay. As long as your investor pool is like, I understand the value here. I might not get distributions for the first couple years, but I know we're off to the races. So getting those relationships with investors right now is really critical.
right, and like everything, there's cycles, and it would only be fair to say, I think too, that in that age of the free money that you were talking about, where it was so inexpensive, and 2019, 2021, there was some distributions. It wasn't that nobody
Oh,
was.
yes.
That's
Oh,
why so
no.
many people got into it. They were meeting 5-year goals in some cases in 18 and 24 months, right? And those that sold quick did great, right? They jumped
Great.
right back in. But so there are the success stories, but there's also so many that did the case study. That was a perfect case study on those that are now in the stressful position of what do we do? We got to cash in to refi, right? Do a capital
Mhm.
call and bring cash to the table. Hopefully they can talk to modify loans potentially. I don't know what the likelihood is of that these days. With the feds, I thought that the feds had put some liquidity criteria in place that meant that the delinquencies had to be remedied now within a certain time frame. Is that true, or is there
I don't
something?
get into that level, but I would tell you that we are expecting a couple reductions from the Fed. Um, you have to keep in mind that the Federal Reserve and the Treasuries, they do not work hand in hand. They're separate. And when we talk about the Treasuries, we're really talking about what's happening in the marketplace. It's public sentiment with the Iraqi war, Iran war rather. We saw interest rates go up about 30 basis points over the last couple weeks. Now, yesterday they came down a little bit, maybe 9 or 10 basis points, but it is significantly based on what's happening in the world. The Treasury, not as much. As you saw, we've had 1.75 over the last couple of years, decreases 1.75, nothing. When I'm going over here on the Treasury in 2 weeks going up 30, we're not seeing it here on the Treasury. So separate, we do think where we're hearing 2 to 3 reductions over on the Treasury, but who knows? There's going to be a change. Hopefully, Jerome Powell, who looks like he's aged 100 years over the last couple of years, right? He's going to be replaced, and we just don't know that replacement if they're going to be bullish on keeping it pretty steady, not dropping. That's what we're hearing. However, as you know, our president wants to really see a reduction there fairly quickly. So it, everything is in flux right now.
Right, right.
Mhm.
So, yes, it's a good time to be poised, is what I say, and watching
Great.
and get your ducks in a row so that because you don't want to catch a falling knife, these properties that have to trade, whether it's the bank that's selling it or the sponsors, there's a deal to be had potentially. But
Yes.
my understanding is from all the conferences I've been to and talking to appraisers that are giving the broker opinions of value and things to the banks and lenders, is that there won't be such a release in volume that affects the market greatly. It's going to probably be more of a trickle, but a lot of it will be who you know and if I mean I feel like it would be awesome to get together a team that can buy notes from
Mhm.
the lenders. What are your thoughts on that?
I absolutely would agree with you. Again, that's going to come down to your relationship with the banks,
Yeah,
right? So you have to have a track record already in place.
yeah, right. So that's kind of what's going on in the market. But so as
Yeah.
we find these deals, for those of my listeners that are looking for deals, and there's plenty of them, if they're
Yeah.
going to call you for a quote, walk us through what you want to have them have already done or to do, and just that kind of a step process.
Yes, sure. So you're going to get from your broker a T12, a rent roll, an offering memorandum. You're going to analyze that with your own underwriting. There's 3 people I need you to reach out to affect your underwriting. That's going to be a tax person, your tax assessor. What upon sale in this county, in this market, what's going to happen with the taxes? Second is an insurance broker. What are the upon sale, how much is my insurance going to be? You're going to be paying more, therefore I need more coverage. You can't take the sellers, that doesn't work. And then the third is a property manager. Are they going to buy into the idea that you're saying, I can raise these rents 5%? Are they seeing it? Do they have market knowledge? Will they be responsible for delivering that 5%? If not, we need to hear from them, and then you put their underwriting into your model. And therefore, at that point, if the deal makes sense, that's when you come to the lender. Now, you could certainly reach out to me early just to say, where should I be underwriting this? I typically say, look at a 10-year treasury and add 200 basis points. I'm sorry, if we're at 4, you add 2, now we're at 6%. So underwrite it at 6, okay? And I would be underwriting these at 65 to 70% loan to value on a 30-year amortization. Once you have that, you see your returns are right around where they need to be for your investors. I would then send me an email with your T12, your rent roll, your underwriting, all of those updated financials. Don't be sending me last July. I need it to be current. And they're all in Excel. And also send me the OM, the offering memorandum. Tell me, I want to pay this amount on this 150 unit building built in 1975. These are the things that I see we're going to need to do renovations of this amount. And then I will underwrite it and I will give you a quote based on those financials. We're going to dig deep into those financials so that based on the performance being equal over the next 60 to 90 days, this is about where it's going to transact. Now, when you do agency financing, the loans will ride the wave of the rate, right? So if the rate today is 629, tomorrow it might be 6. The next day it might be 675. So make sure you know, maybe pad it a little bit so that the stress test on this works in case, over the 60 or 90 day period, the rate changes, you're still okay for returns. So that's the process. Once I return a quote to you, you would put my underwriting in so that, hey, your biggest partner is going to bring 65%. I've written this at 75%. Does it still work? And if it does, that and only then is when you put in an LOI, a letter of intent. Don't be putting in letter of intent to just get a reaction because you don't know if the lender is going to be able to provide the 75 or 80% that you've underwritten it. Now you've put in an offer for 5 million, it probably should be only 4. Again, one of your partners, people you're going to do business with, is a broker. And if you come in and you put in an LOI at a too high of a rate, and you come back down and you say, oh, sorry, I messed up. You're putting yourself at risk, that relationship at risk, and you might not see more deals in the future. So be thinking about that, follow that process, and I'm here to help on all occasions. So that's
Right.
how that works.
And for the exit cap rate, what are you generally looking for your clients to be doing? Is there a rule of thumb that you're
Yeah, I would tell you I look at that from an owner operator standpoint. The lender does not really look at that unless we're doing bridge loans. But from a lending perspective, we're really only worried about the debt service coverage. We want to make sure that this asset is going to be paid, the lender's going to be paid off or paid monthly. We don't care if you're getting 100% return. We want to know that it is being paid on a monthly basis. From an owner operator standpoint, I'm going to look at, first of all, and this could go into a long, long discussion. Cap rates in this market are very difficult to use as a true meter because there hasn't been a whole bunch of transactions completed. We can do high level. We think it's 6.5. We think it's 5.25. But it's really going to come down to what the borrower and the seller are going to be able to come up with. We're going to give you high level indications, but I would say you would want to raise it, just rule of thumb, about 10 basis points a year of hold. So if you go in at 650, you're going to sell this at 7, there's your value. No more 25 a year. At one point it was like that, but we don't see that. And even some people are saying, "Hey, I think the cap rates are going to come down while I own this." I don't recommend doing
Right.
that.
Seeing a lot of that. I'm seeing a real lot of that. And
Mhm.
I totally agree with the 10, percent per year hold. I used to be an appraiser, right?
Yes, I
Yeah.
do.
Okay. Yeah, I thought you did. So yeah,
Mhm.
I subscribe to a lot of those old rules of thumb too.
Yes.
And, yeah, but so as far as the DSCR though, is that 1.25? Is that the magic number still?
That's pretty much the magic number. You can find some lenders that will go to 1.15. You can find some that are up at 140, 155. So it just depends. It runs the spectrum. Uh, Banks are usually 125. Agency, again, it depends on where you are. If it's tertiary, you're going to be at 135, 140. Tertiary small market. Standard and top markets, 120, 125.
Right.
Mhm.
And so once you have a purchase agreement, let's say you're progressing after the LOI, they're doing
Yeah.
diligence, the sponsors are working away, but they're also providing you the data that you need. So why don't you talk about what you want happening at that point?
Yeah, so we're going to, during that, we're going to have an application right away. You're going to sign an application. There's typically a charge when we do it the agency, there's a charge, and that gets the appraiser, that gets the inspection going. It's typically between 15 and $25,000, and that is at risk. That is pursuit costs that you could lose. So we get that application going. We're also asking for your personal financial statement. We're looking for your LLCs. We're trying to understand what you own, what your experience is. So we'll ask for that up front a lot of times, and we'll start the vetting. We vet the owners and we vet the property. So during this 60, 90-day period, we're doing both of that, running those in parallel. Once we decide, okay, we are under inspection, we have received the appraisal back, we're going to give you, there's like, we're at day 40, let's say. Um, we're going to give you a commitment that's saying, today, you're going to be paying this amount. Here's your rate. You sign it, and then that's your commitment. There's usually a 1% fee to lock that loan. And then about 5 days later, 3 to 5 days later, you will close and you'll have signed all your documentation and now you're the owner. So that period is typically a 60 to 90-day period. On banks, you can do that at 30 days. It's much faster. Have all your information ready, your personal financial statement, schedule of real estate. Make sure you're going to need to pull and show your equity, your balance on your statements. You'll need to have, on a bank, you're going to have 2 years of and maybe 3 years of your tax returns. Again, that's your global cash flow. On the agency, we're just going to need your bank statements that say, hey, I do have this liquidity. I am putting money into this deal, and we can verify that. And so that's the process. And we're holding your hand all along, bringing our lenders, and we are really the quarterback of all these deals.
Right, for sure. Yeah. And you do want to see all these reports that we're getting, right? You want to be privy to most especially environmentals are required, right? And as far as the inspection reports, do you actually get copies of the full reports or do you just
Not necessarily until we close. Typically, we'll get a summary, and they'll say, hey, you've got $1 million of deferred maintenance that needs to be taken care of over the next 6 to 12 months. Here's your bill. And they will take that money. You won't know that until several, maybe a couple weeks before. And you could even go out and get some quotes. They say 1 million. You say, no, I found these are all quoted at 800. Then they'll only take 800. Thank God. If you're not given that information, they will just say, I'm taking this. You're going to do the renovation of those or the improvements, and then we'll give you the money to pay for that. Um, so um,
You're saying put it in reserves?
put it in reserves.
Okay.
Correct.
That
Yeah,
needs a release from the bank?
correct.
Okay. Yeah. So like a draw schedule then, right?
Yeah,
Okay.
you just send in your information, and then they would reimburse you, or they take it out of your reserves.
All right. And so for the reserves for operating costs, what are you typically seeing the banks or the lenders to require?
Yeah, I would say you're usually it depends on the age of the asset, especially on agency. So if it's a newer asset, I would say 250 per unit, 250 a unit per door. Um, and they will collect that on a monthly basis in your mortgage. The other thing is, if it's a older property, it could go up as high as 400 a unit. Now, if you get into another type of loan, a HUD loan, it because those are held for a very long time, they could be 1,000, 1,400 a unit. So it'll just depend on the asset and the age, what the reserve account looks like.
And at closing, there needs to be a balance already there in most cases, right? And then you're talking more about the ongoing or no?
Correct. Yes, that's correct.
Okay.
And they will also collect for your insurance a year in advance, right?
Yeah.
Taxes as well. So there's a large amount of money that gets transacted.
Well, this has been very insightful, and we do need to wrap it up. I am wanting to do a webinar with you, though, because I think that you can do probably a PowerPoint to help demonstrate even more.
Sure,
And you are so knowledgeable about all this. I really appreciate you going into so much depth. I want you to
sure.
say your takeaway again, though, for the listeners.
Yeah, so I would say the biggest takeaway today from my position, whether I'm an operator, an owner operator, or a investor, or even a lender, know who your partners are on all levels. Can you be with them in a relationship with them for 5 years, 7, 10, 12, 30 years, depending on how long you're holding this transaction? If you're an investor and a limited partner, go back, see the success of this operator. What is their success stories? How much have they delivered? How much have they lost of people's money? Are you wanting to be in relationship with that operator? From an owner operator standpoint, you've got people coming in who are going to asset manage the property. Are they on the same wavelength as you? Will they watch over the property on behalf of you and the team? So know who you're doing business with.
Right. If you're doing a value add plan and you can't execute on that, you've got to have the people on site that can execute, or it's a goner. Yeah.
Correct. Yeah.
Yeah. Terrific. All right. So, and as I ask everybody, is there a pivotal person or event that brought you to where you are today or is pushing you towards some particular goal?
Well, I would have to say my partner in crime, my husband Robert.
Yeah.
He always keeps me steady on my feet. We don't always agree, but where we disagree, we can come to a middle ground. We have 4 kids, as we mentioned earlier, and so where I'm really hard-headed, he comes in quietly, and so we're a good partnership, and um, I think that I'm inspired by him as
All
well.
right. So, and does he get into the lending piece of it too, or does he have a separate job, or what?
He doesn't. And as I mentioned to you, he's more on going stocks. I'm more on real estate. So if there's any difference, we're able to make it work. So you don't always have to agree on everything, but you have to be kind to each other as you walk through this journey.
Terrific. Well, and I love it when people do say that their partner is their spouse, their husband, wife, but partner. And so, as I explained before we started recording, what we do is we like to recognize those pivotal people. So if he'll come on the show,
Oh,
we'll promote him as pivotal, and he goes on our newsletter forever as a pivotal person, and he gets a lapel pin that says he's a pivotal person. So
oh, that's
I'll leave
wonderful.
it to you. Can tell us if you're going to let him know, or if you want us to call him and say, "Hey, you were nominated." But
I'll let
that's
her
what
know.
we.
I'll let her know.
Okay. Well, very good. Well, so tell people how they can reach you.
Yeah, so I'm on all social media. Again, I'm Julie Anne, Anne Peterson. I'm on social media, LinkedIn, Facebook, Instagram. Feel free to send me an email, jpeterson@oldcapitallending.com. Happy to spend some time with you and Zoom at 8. You need to come join us every Tuesday night. We've had this for 7 years, as mentioned, and it is a way to meet other people. You know, finding the time to jump in your car, drive an hour, spend an hour, drive another hour back, that's a 3 hour commitment. At Zoom at 8, you show up 8 p.m. Eastern, and we are together for an hour and a half. You can meet people. We have vendors who come in, talk about their properties. They come and talk about their products. We are there to network and learn from industry experts. So every one of you is invited. You can sign up Zoom at 8, ZOOMAT, and the number 8.com. And you can sign up there. So
It is very productive. I can vouch for that. It's a very good conversation. So
thank
thank
you.
you so much for coming on. I
Thank
really
you.
appreciate it.